Hi everybody, so this discussion is on impairment of assets. So I have this situation. Around the Circle Incorporated creates handheld fans, and due to economic conditions, the company needs to do a recoverability test to determine if the machine that produces these fans is impaired because their sales has dramatically changed or dramatically slowed down. So there is a three-step process to determine if an asset is impaired. Step one, we estimate the future, let me get the future spelled right, future net cash flows, your inflows, your sales minus your outflows, would be your expenses. Find the book value of the asset in question. Remember, book value is your cost minus your accumulated depreciation. And if the book value is greater than the estimated future cash flows, then the asset is impaired. If it's impaired, we look at the difference between the book value minus the fair value, and that gives you loss on impairment. So we have presented below the following information related to the equipment owned by Around the Circle. So we have a cost of $9 million. Accumulated appreciation to date is $1 million. Estimated future net cash flows is $7 million, and the fair value of the equipment is $4,800. And assume Around the Circle will continue to use this asset in the future. As of December 31st, 2000, we'll say right now 16, the equipment has remaining useful life of 4 years. So let's prepare the journal entry, if any, to record the impairment of the asset. Okay, so we'll come up to here. So step one, that was estimate future net cash flows, your inflows minus your outflows. Well, luckily for us, they have given us that as $7 million. We didn't have to figure that one out. Okay, so that was the easy part. They're all easy if you follow the steps. So step two, find the book value of the asset. So the equipment cost, let me go ahead and get that a little bit more. The equipment cost was $9 million. Make sure we get enough zeros going in here. Had to make it a big number, didn't I? Accumulated depreciation, I'm going to abbreviate just a little bit there. That they told us was $1 million. Let's see, got another zero on there I need to get taken care of. Okay, so our book value on this asset, let's add those together, is $8 million. Okay, step three, if book value is book value greater than future net cash flows. So we have let's get all these zeros in here. Whoops, wrong way. Let's learn my Excel. Is 8 million greater than, make sure I got enough zeros in there again. Is 8 million greater than 7 million? Yes. So at this point, the asset is impaired. Okay, so if we want to the impairment process, okay, we're going to take our book value, which we determined was the $8 million. Sorry, did not ahead of time get those in there. The fair value, see if I can spell today, that is the $4.8 million. Okay, subtract those. That gives you your impairment amount. Okay, so we need to prepare the journal entry. Step 1, 2, 3, and then if it's impaired, considering the 4th step, that is the impairment. So what we need to do for the journal entry, it will be loss on impairment I'll do it this way. Notice, let me move this out just a little bit here. Notice that when I did the credit, I'm not reducing the amount of the equipment. What I'm doing is I am bringing down the balance of the, let's see if I can get enough zeros in here. Try to talk and type at the same time. Sometimes it doesn't work out. What I'm doing is I'm taking that accumulated depreciation and I'm bringing it down. Let's do a real quick, let me see if I can do this in a quick manner here. Let's do, let's see here, let me find it. We need to do our double T. That's going to make it all better here. Okay. And I need one more under there. Okay. So we had to date accumulated depreciation, 1, 2, 3, of $1 million. Okay. We added, so that gave us a see how I'm doing this? Okay, so our debits are credits. So then we did another 32 million. Sorry about that, I did not get those in here. So then what that does is that brings us up to 42 million. Now, remember the cost was $9 million? Our new depreciation is, I think I've got too many zeros in the one. Yep, I thought I did. Okay, that's not to do that too much. Okay. Take the difference between them. Okay, what I've done, this was the first step. I reduced my accumulated depreciation by the $3,200 to get to the new fair value, which we determined was $4,800. Okay, so I'm not ever touching that equipment. Okay, so then what they want us to do next, so we're not done yet, and if the fair value would have gone up, then we wouldn't have done that. So for our part B, they wanted us to prepare the journal entry to record the depreciation expense for 2015. Okay, so let me do this. I like that formatting, so let me do another formatting here. Okay, so depreciation expense and accumulated depreciation. So now we're going to be taking the $4,800 and dividing it by the 4. Okay, so you take 48, 1, 2, 3, divide it by 4. You're going to get, this is the amount of depreciation, and that will be the amounts there. Okay, so part C. So I guess this was Part B. Part C. The fair value of the equipment the following December is $5.1 million per the journal entry. If necessary to record the increase in fair value, no entry. According to GAAP, we do not increase the value of the equipment once it is brought down. Okay, this is per GAAP. If you were doing IFRS, IFRS does allow an increase in the, to reverse some of that, the difference between the 48 and the 5.1 million. But what I'm concerned about on this one is an impairment using GAAP. So there is no entry. We do not increase this. Now, if we had the year 3, the fair value of the equipment went down even more, and our net cash flows was down again, then we would also do another impairment. And this is on equipment that is continuing to be used. Okay, if we were deciding we're not going to use this piece of equipment anymore, then we would just sell it. But this one, we're going to still use it. It's just that we need to bring the value back down so we kind of have a little bit better alignment. So that's my discussion on impairment. Thank you.